Good afternoon, everybody, and thank you for joining us. My name is Michael Magnato, and I'm the team lead for American Physical Clients here at Kepler. Welcome to the Market Pulse Americas webinar series. It's a new initiative designed to bring Kepler and marine traffic directly to our clients and partners across the Americas. These sessions are available in English, Spanish, and Portuguese to better support the full breadth of our regional audience. We launched this series in response to a growing demand for sharper, localized market insight, particularly in LNG, as we're going to cover today. We're shifting trade routes, new infrastructure, and evolving policy are driving rapid changes. Right now, we're seeing a surge in the Pacific Basin activity, while Europe and Asia continue to dominate the conversation around LNG flows. North America, and especially the US Gulf Coast, is emerging as a global leader in exports. It's helping reshape market balances and price dynamics across the world. It's why exactly we're here today and why we created this series. It's to help you and all of our clients make sense of these changes with clear, data-driven insights from Kepler and marine traffic. For those of you who are new to us, Kepler, a quick summary. We're a global technology company delivering real-time market intelligence across energy, commodities, maritime markets. We combine advanced data infrastructure, AI, and deep industry knowledge to help clients track and anticipate flows in LNG, crude, refined products, dry bulk, power, and more. On the marine traffic side, part of the Kepler Group, we operate the world's largest, most expansive AIS network, providing real-time and historical vessel tracking, port congestion analytics, weather overlays, fleet intelligence to support smarter decision-making across the shipping and logistics value chain. Now, today's session focuses just on natural gas and LNG, and I'm really excited to introduce our speaker, Anna Basic. She's an insight analyst for our natural gas and LNG here at Kepler. Anna leads our global LNG analysis with a strong focus on the complex dynamics of Asian demand markets, as well as key supply side issues like sanctioned Russian Arctic projects. She has been instrumental in developing many of our insight LNG demand models. She currently oversees our demand overlooks for Northeast and South Asia, regions that remain critical drivers of long-term LNG growth. Before Kepler, Anna spent several years covering power markets, developing over 10 large-scale solar and wind projects. She's also worked on government-commissioned initiatives for high-capacity renewable energy buildouts all throughout the Middle East. It's really giving her a truly global and cross-sector understanding of the energy transition and infrastructure evolution. So please feel free to drop any questions in the chat during the session. We'll leave time at the end for Anna to answer as many as we can as they're coming in. We'll read them and make sure they're queued up. As a quick reminder, full webinar details, including upcoming sessions, can be found at the registration page, the link posted in the chat. With that, very excited to hand it over to Anna. I'm done talking now. Thank you so much for joining us. We hope you enjoyed today's session.
All right. Well, thank you, Michael, for that very sharp introduction. Hi, everyone. My name is Anna Subasic. I'm as I said, LNG nat gas analyst at Kepler Insight, covering Asian markets. So without further ado, let's just jump into today's presentation on Asian LNG demand. We have a lot of stuff to cover. So starting with the agenda, so today's webinar is going to focus on major Asian LNG importers. So that's China, Japan, Korea, Taiwan, India, and Thailand, leading up to this winter. And we're going to start with a recap of the first half of the year. And then we're going to follow this by a base case of the forecast, which will focus on the July to October period. And then after that, we're going to discuss some high and low scenarios for the same time period where we kind of stress test our assumptions. And I just want to highlight that our Asian LNG demand coverage is very bottom up. And we have models that are covering over 100 variables. So it's a very in-depth look at the regional balances. And just a heads up as well, a later point in the year, there will also be a webinar that is focusing more on the winter outlook itself. So let's keep an eye on that as well. So let's just begin with a quick recap of the first half of the year to kind of set the stage for the Q3 base later on. First thing to note is that actually Asia experienced its warmest winter on record. HDDs were well below like the 5 and the 10-year averages across major cities, which was sharply cutting back heating related demand. On top of this, we saw that LNG prices remained quite high compared to the first half of 2024. And they were driven by geopolitical uncertainties, Ukraine, Red Sea crisis, Israel-Iran kind of tensions, and so on. On top of this, we saw generally like tighter LNG supply, which was creating affordability challenges for price-sensitive buyers. And we generally saw a stronger competition from Europe amid the kind of loss of Russian pipeline flows. As a result to this, we can see that Kepler data is showing us here, like on the right, LNG imports across major Asian markets dropped to 117 million tons, which is around 10 million tons less than last year. Notably, China alone accounted for around 9 million tons of this decline. Primarily, this is reflecting a structural change in the gas supply strategy, but we're going to unpack that in a bit more detail in the next slide. But before we get to the kind of bigger, China picture, we can discuss a bit more of the dynamics across the region. So first of all, I would say we saw very contrasting trends across the regions like power sectors. If you look at the center chart over here, most countries reduced their LNG usage for power generation, but South Korea ended up bucking the trend a bit. And this was mostly because we saw some temporary nuclear outages and some short-lived cold snaps, which drove up gas-fired power generation. At the same time, Taiwan held relatively steady, and Thailand experienced weaker power demand due to what was unseasonably cool peak demand months. We should also mention that elevated LNG prices really hit industrial users, especially in markets like India. You can see here that many consumers switched fuels, leading to this significant drop in LNG consumption across non-power sectors. And then looking at the chart to the right, this is where kind of like the trends become a bit clearer. So in China, we said gas supply increased despite the drop in LNG imports. But in places like Japan, so more mature markets, LNG demand actually eased because power needs declined and nuclear availability improved this year, which was also lowering overall inventory drawdown. At the same time, South Korea, by contrast, leaned onto intensified inventory drawdowns during Q1 to kind of offset some of the grid bottlenecks that are happening on the eastern coast of the country, as well as some general like coal limitations from coal facilities that we saw at the beginning of the year. So overall, I would say that the key takeaway here is that it's a combination of shifting supply and also softer sectoral demand that is kind of like reshaping this balance across Asia in the first half of the year, and that's significantly reducing spot activity. But still looking at this chart to the right, China is popping up quite dramatically. So let's take a deeper look at the kind of largest contributor. And so if we were to zoom in on China, we can see, as I kind of mentioned, China witnessed the largest drop, 9 million tons year on year to 40 million tons total. And the question is, what is behind that? I hinted a little that it's more of a supply side story as opposed to a collapse in demand. And it reflects a structural change in the country's gas supply mix. Specifically, it's showing a shift towards cheaper domestic and pipeline gas at the expense of the kind of higher priced spot LNG. So gas demand growth on the chart here to the left is expected to somewhat stagnate this year, but that doesn't mean it's going to necessarily decline. We see an increase of 13 BCM year on year, which is a marked slowdown from 2024 levels. And I think the key driver behind the slow growth was this weaker industrial activity that we saw, which we also observe via our Kepler proprietary industrial activity tracker. And it's showing us that the sector was weighed down by the broader kind of macroeconomic headwinds and tariff pressures. But besides industrial activity, we also saw lower gas for power demand due to milder winter temperatures. So now looking at the kind of center chart, we can see what's happening also on the supply side. So specifically looking at these blue and gray bars, they show the two biggest contributors, so domestic production and pipeline imports. And domestic output actually performed exceptionally. Key producing provinces were the Shanxi province and the Sichuan province, which hit storage refill targets early under the 14th five-year plan. And while output dipped during February, when we saw that there was kind of the classic Lunar New Year period, it rebounded also quite quickly through April and May. And then when it comes to pipeline flows, it's Russian gas via Power of Siberia, which approached near design capacity in early 2025, while we also saw some gains from Central Asian pipeline flows because we saw that there was in general milder regional weather, which was reducing like reliance on LNG even further with more gains from pipeline imports. So thanks to strong supply, mild weather. We can also comment on China's storage, and this is like our proprietary inventory model as well. We're seeing that storage remained exceptionally high, and it actually peaked at 90% in February, so at the peak of kind of winter in the Northern Hemisphere. And then it stayed above 70% through the first half of the year. So this is well above historical norms, and it represents one of the most bearish signals for regional LNG prices so far this year. So I would say with that kind of backdrop to LNG led demand loss from China in the first half of the year, we can also shift gears and talk about what's ahead and talk about our base case. So firstly, I think we can walk through kind of the key demand side assumptions that we're making when we're underpinning our base case. And again, these are derived from our in-house bottom-up models, integrating over 100 variables. But for today's discussion, we kind of like pinpointed the ones that we think are going to be the core drivers and the most critical to kind of the LNG and gas outlook in July to October. So first, we can comment on the temperature. We track temperatures using population-weighted cooling degree days, which capture how intense the air conditioning is going to be overall. We also use national weather agencies to kind of use their long-term guides as well. So 3-month outlooks from JMA, CMA, KMA, and so on. For this summer specifically, most of the forecasts are pointing to above normal temperatures for Japan, China, Taiwan. Meanwhile, India and Thailand, they're expected to see like cooler than average conditions because of this early onset monsoon season. And by contrast, South Korea is forecast to experience a near normal summer. Next up, we can talk about hydropower and renewables as well. So this is where we look at the load and the capacity factors, which kind of influence gas demand by displacing thermal generation when it's available. So in China, hydro output is assumed to like revert to the historical average, lower than 2024 levels, but above the 2023 drought year levels that we saw. At the same time, Thailand should see a higher hydro generation because of heavier rainfall. On the renewable side of things, I think we can mention South Korea, which is benefiting from a lot of like grid upgrades and new capacity. And then also China, where we see like the renewable impact is muted by some transmission limits, but we do see strong capacity build out through the year. And Taiwan as well, we can mention that we do see gains in renewable production because basically like coal and nuclear are being phased out. And with that, we can talk about nuclear as well. Nuclear availability is another key variable. So when it comes to Japan, Japan has around 10.7 gigawatts expected online during this period, so that's a 1 gigawatt increase from last year. South Korea is around 22.4, so that's slightly higher year on year, but it's reflecting like fewer planned outages in Q3. And with nuclear availability, we can also, very important to mention, Asian spot LNG prices. So our base case right now is using our in-house monthly price forecasts, which currently are at $11.9 per MMBTU for the period. And that's high enough to curb demand in price-sensitive markets, especially China and India. And then lastly, we could mention GDP growth, because economic activity is also something that kind of feeds into the non-power sector demand, especially industrial gas use. And so our macro view sees like growth as flat to slightly lower. And we kind of present, which kind of like limits the scope to demand recovery outside of the power sector in general. But when we present our high and low cases later on, we will also talk about like adjustments to GDP growth and all of the other core drivers that I mentioned. So together, it's kind of like these variables form the foundation of our current base case outlook, which is driving both, the regional trends and the country level nuances that we are seeing in the kind of overall LNG demand. So to talk now specifically about what the base case is, we can start with the kind of left chart on the left, which shows that there's going to be like a year-on-year comparison of LNG imports across key Asian countries, and most are going to see a decline. Overall, 5 MT year-on-year to around 79 million tons. So Japan specifically will import around 21.7 million tons. So that's about 0.7 MT lower than last year. At the same time, South Korea comes in at around 13.2, so that's nearly 2 million tons down. And then China's imports are expected to fall to around 24.2. That's still a 1.6 MT drop. And then India is also worth mentioning because it also declines by around 1 MT to 8 MT total. And I think the trend is pretty clear. Like all countries here on the chart to the left, except Taiwan, have reduced LNG demand. And the largest declines are definitely coming from China, South Korea, and India. And to understand why, we can talk about and look at the second and the third chart. So the second chart over here is showing the year-on-year deltas, and it makes it visually clear that nearly all markets are reducing LNG imports, but the reasons are differing. So for China, the reduction continues to be supply side driven, while in other countries, demand side factors are more prominent. So on the demand side of things, I think Japan, South Korea, both are going to lower their gas for power demand because nuclear output is increasing, which is displacing LNG directly in the power mix. Thailand's decline is again cooler temperatures, weaker cooling demand as well. In contrast, China see a rebound in non-power demand, which we'll also touch upon in a bit over the next slide. But Taiwan is also worth mentioning. It's the only country where LNG demand rose, which is reflecting this like structural growth in gas for power because again, nuclear capacity is phased out and new gas plants are coming online. So before we move over, like let's just talk quickly about the right-hand chart as well, because that's more of a supply perspective. So this is where like China comes into the picture. China's domestic gas production is ramping up because of the unconventional gas fields that are ramping up and as well pipeline imports. So that's especially again Power Siberia, all growing rapidly. And this increase in supply is definitely outpaced the demand growth that we are seeing and pushing kind of LNG out of the mix. So with this overview, we can take a look at some of the deeper drivers behind the largest kind of losses year on year in the base case. So as I kind of mentioned, it's going to be China, South Korea, and India, which remain the largest contributors to LNG demand weakness across Asia, July to October. In South Korea, the pullback in LNG is mainly on the power side. As I said, nuclear availability is going to remain strong around 23 gigawatts, with fewer outages scheduled compared to last year. So that's also combined with some steady renewable output and relatively mild summer temperatures. And this is all going to limit a lot of the gas burn for power generation. So on top of that, we can also just say that, storage levels also remain quite comfortable, which is reducing the need for spot replenishment in general. Moving to the middle chart, you can see that China's domestic gas supply continues to ramp up. That's putting downward pressure in the July to October period. And so domestic output from unconventional sources is set to rise further. And Power of Siberia, again, moving closer to capacity design. And these two together are kind of covering the incremental domestic demand, and that's effectively like squeezing out LNG spot volumes. On the demand side, there's some like recovery when it comes to China and the non-power sectors. That's particularly in the RESCOM, like residential commercial sector, and LNG trucking, which is supported by, in general, like seasonal upticks that we see and some moderate price responsiveness as well. However, these gains are again not sufficient to offset the supply side displacement. And then moving to the right, we can talk about India as well, where like high spot prices are expected to remain like a key constraint, with prices around like $11.9 per MMBTU for the period. We're going to see like LNG is likely to remain uncompetitive in key industrial sectors. You can see this from the positive side of the spread on the chart, especially because we know that fuel switching continues to be viable. And the power sector as well isn't expected to provide a much upside either. So overall, we anticipate that there's going to be weak industrial demand and some limited flexibility in the power mix to kind of keep like the LNG intake soft. So I think the key takeaway here before we move on is that the headline trend is the drop in demand, but the underlying dynamics are very different. So China's outlook, supply like alternatives, South Korea is going to be reduced gas for power need, and then India is the price-driven like industrial weakness that we just kind of discussed. So now that we've kind of like given you an overview of our base case, we can now talk about some of the high and low demand scenarios for the same time period. So starting with the high case, which represents kind of the upper bound of our forecast range. So this serves as a very useful like stress test to market resilience, especially in respect to spot prices and gas burn in the power sector across the kind of July to October window. And looking at the assumptions really quickly, which you'll remember from the table that I showed in the base case, we've dialed in more extreme conditions across key variables, but only where we determine that there is a realistic probability for these. So weather is expected to be hotter than normal. It's benchmarked to the 5-year maximum in terms of cooling degree days. Hydropower output is also at the 5-year minimum load, which is then limiting kind of renewable competition. At the same time, nuclear availability is reduced by around 1 gigawatt. So that's incorporating any like unplanned outages or extensions, like for example, the Kansai Takahama 3 outage into October. Also, we can mention renewables. They're also assumed to underperform here, modeled at minimum like solar and wind capacity factors for over the past 5 years. And then spot LNG prices are modeled at $2 below the base case. So that's bringing them closer to the kind of $10 threshold. And that makes LNG considerably more competitive in price sensitive markets. And I also have to mention GDP growth assumptions. We don't change them in this scenario because we find it difficult to realistically like increase assumptions. We're already expecting 5% for China, 6.2% for India. So we're not layering any like new macroeconomic uplift here. So this kind of mix of tighter like supply alternatives, lower LNG prices is reducing and a noticeable increase in gas demand, particularly for power generation, where switching becomes more attractive. And this is where you see the high case is adding a total uplift of 4 million tons and LNG demand. That's pushing regional consumption to around 83 million tons across the key Asian importers. And you'll see on this chart to the right that China is leading the gains with an additional 2 MT. It's driven by cheaper LNG and suppressed renewable output. That's the main kind of growth. And then we can also mention some other bigger ones. So for example, South Korea here is adding around 0.8 MT. So that's assuming that there's hotter weather than we're seeing in the base case. But Japan on the other side only sees like around an zero point 0.6 limited upside because we already assume the base case is very elevated in terms of like summer temperatures. So crucially, this like scenario reinforces the importance of like price sensitivity within our models. In both China and India, LNG, as I said, becomes more competitive around the $10 mark, and that's prompting some incremental demand, especially in the industrial and power sectors. But for India specifically, you will see as well that alternative fuels still remain somewhat cheaper. So industrial users are still somewhat like staying away from LNG in this few month span. And while, weather is also playing a role, but this is mostly on the high case, like a price related upside case. And China is the most responsive market in that sense under these conditions. So now that we talked about the high case, maybe we can touch upon the low case as well. So our low demand scenario here is going to be the opposite of assumptions that we have adjusted in the high case. And that reflects like this convergence of bearish inputs across like weather, energy mix, pricing, macroeconomic conditions again. So the assumption is that we've like applied more pessimistic settings across multiple variables. And so temperature is now going to be the 5-year minimum. So that's signaling in cooling degree days. So that's signaling like cooler than normal conditions that reduce air conditioning loads. And with that, the overall power demand. Hydropower is assumed to be strong in this scenario. Maximum load factor is applied for the 5-year average, particularly for China and Thailand, where hydro has the potential to kind of displace more significant volumes of gas. For nuclear, this is where we assume no incremental gains because reactors are already running like either at full availability in the base case, or we don't see any shortening of the maintenance, or there are like no new early like unit restarts. So that's something to keep in mind as well. But renewables, again, are modeled at the 5-year highs for solar and wind capacity factors. So that's also further suppressing gas in the power stack. And then, of course, spot LNG prices assumed now around $14 per MMBTU, which is $2 above the base case. And it's well beyond the kind of affordability thresholds for key markets like China and India. So on top of that, we also factored like a 0.5 percentage drop for GDP. So that's a reduction versus the base case, and that's mostly to kind of reflect the trade-related like headwinds that we might see, including the impact of possible like new US tariffs. So if we look at all of this like taken together, then these assumptions are driving like a very broad reduction in gas burn, especially in the power and industrial sectors, where we see alternatives are more available, LNG is less competitive. So looking at the results, we see here that it's going to be a total LNG demand fall 7 MT, so 7 million tons to 71 million tons across key Asian markets over the July to October period. And cooler weather in the total is kind of the overall largest contributor if you're looking at this chart on the right. So that's accounting for nearly 3 MT of the decline. And Japan is alone making up for around 2 MT of that, given already that we're seeing like a hot base case when it comes to temperatures. And then higher prices also are trimming demand by another 1.2 MT. So China, it's like a 1 MT reduction. India is like a zero point 0.2 MT reduction. Those are the most affected ones because prices are again moving well beyond their switching thresholds. At the same time, stronger renewable output, especially in China, is then displacing another 1.4 MT of LNG. And then the low GDP impact is also shaving off around zero point 0.5 MT, mainly in China, where we see that the kind of growth is more closely linked to non-power sector gas demand in general. But then you'll see, like in countries like Japan, for example, the macro effect is negligible because we already like assume like a low underlying growth. So I think for this scenario is it's kind of like important to recap that like it reinforces a more bearish outlook, especially with like China, Japan, South Korea. Those are accounting for the bulk of the kind of projected demand contraction here. So with that, we can talk about kind of closing up this section of the risk scenarios, talk about the scenario results with a quick summary of our like high and low demand results across the months, but also across the drivers. As we hinted, a bit already. Like our modeling makes it clear that the downside is clearly like outweighing the potential for the upside in LNG demand in the July to October period. So I think in terms of like the forecast range, that shows the widest spread in July and August. And this is where we see like a gap of 3.5 to 4 million tons between the high and the low cases. And the variation is largely driven by weather uncertainty. So that's ranging from like heat waves to cool snaps and the market sensitivity to LNG spot prices as well. So if we take a look more closely at like on a month-to-month basis on the right here, like the greatest downside risk is concentrated in July when there's like a combination of cooler than expected temperatures, higher LNG prices, stronger renewable output. This is all like slashing demand by as much as 2 MT. On the flip side, the strongest kind of upside potential is from July through September. If like conditions align, if we see like hotter weather, weaker renewables, more affordable spot LNG prices, we could see demand lifted around 1 to 1.2 MT a month in the high case here. And then I would say like by October, you can clearly see that the scenario range narrows considerably. This is around 1 MT now. Temperature variability is significantly declining, and then spot price dynamics remain relevant. But this is especially again for the price sensitive markets like China and India. So I would say that the bottom line is kind of like summer demand is clearly skewed to the downside in our risk case, but we see the risk balance overall beginning to stabilize as we head into the autumn, like shoulder months, which is like, just ahead of the kind of winter ramp up that happens. So with that, that's kind of like the run through that we had for you today. And I can talk about like the key takeaways that everyone should be walking away from today. So starting with the base case outlook, I think Asian LNG demand is expected to remain quite soft through the July to October period, with total volumes projected around 5 million tons lower year on year. And the decline is primarily like driven by three key markets. So it's going to be South Korea, where increased nuclear availability, again, it continues to displace gas in the power mix. Then China, where rising domestic production and ramping pipeline imports, particularly from Power of Siberia, are also curbing the need for spot LNG. And then India as well, where fuel switching is persisting. So high spot prices are keeping LNG out of the reach for a lot of the industrial users here. So, from our scenario analysis, the most important swing factors here to watch out for are going to be the kind of weather variability first, especially around the cooling demand during peak summer months. And then spot LNG prices, which also remain like a key determinant of demand in price sensitive markets. And then when we look at across the full forecast range, again, the downside risk around 7 MT is very clearly outweighing the 4 MT upside. And again, largest sensitivities seen in China, given that we know there's like a flexible supply mix now, and Japan, where temperature variance has like a stronger impact on gas burn, because again, we assume like a very hot summer in the base case. So even under like more supportive conditions, hotter weather, lower prices, weaker renewables, the market outlook remains structurally quite bearish. And I think this continued like bearishness across Asia is definitely like the key takeaway today for the kind of July to October period. So I would say that's it on the market analysis bit. So thanks very much for your attention, and happy to get into some discussions around this. And with that, maybe let's bring it back over to you, Michael, and we can go into the audience
Cool.
Q&A and maybe the offering as well.
Yeah, cool. Thank you so much, Anna. I joked because you had the difficult job today. I have the easy job of just introducing you and talking about what we have to offer a little bit. But before we get into the questions, thank you again, Anna. But if anybody here is interested, dive a little bit deeper in the kind of insights you saw today, I encourage you to explore Kepler's full suite of LNG and liquids market intelligence that we have. As part of our service, clients receive access to our weekly and monthly insight reports, real-time data tools, and direct engagement with our team of expert analysis, including Anna here and others across the globe. We have about 300 to 400 analysts globally now within our research group. Whether you're focused on trade flows, supply demand fundamentals, infrastructure development, or market pricing, our goal is to equip you with the best information and context that you need to make smarter decisions. With that being said, I wanted to get to the questions because we have a few of them that rolled in here. Anna, starting actually, this is a good one. But in your base case, why do you see that uptick in Chinese LNG imports in September when you show both pipe and domestic output are performing well?
Mm, yes, good question.
Sure.
I think this was in our base case charts when you showed like a monthly evolution of the domestic like gas supply picture in China. And it's true that we see an uptick happening in September, and I think that reflects two key reasons. So the first one is going to be the commissioning of like a new LNG terminal that is coming online in July and August. So that's going to be the Longkou terminal in the Shandong province. So because of that, that's kind of like triggering this wave of initial like inventory injections. And then second of all, I would say that at this point, it's where our models start to kind of show this rebound in non-power gas demand that I mentioned. Notably, again, from like the residential commercial use, like the rescom and LNG trucking, and then post-summer like commercial activity as well. And this includes harvest-related demand as well, and it's followed by a very, very modest uptick in the industrial and chemical activity based on the signals that we are seeing from our industrial tracker within our China model.
Gotcha. So there's more, as you say, there's more diversification in the consumption in China. Okay. All right. Uh, Back off that actually, another one came in about China. Do you see any increase in US LNG exports to China during
Mm,
Q3 and end of the year?
Oh, yeah. Thank you, Michael. Yeah. Um, No, we do not. Because
Dang.
right now, I mean, under the current regime, the US import tariffs to China are still at 25%. So, like, LNG source from the US remains still quite expensive compared to kind of like the cheaper and alternative suppliers like Qatar. But we are keeping like a close eye on any like developments that are happening because apparently. Like as you might have noticed today, there was some news about trade talks that have been wrapped up in Stockholm, and there is some potential for extension of the 90-day truce. But this will again depend on what President Trump has to say as like the final word. So it's not unlikely that we could see an extension, and at least for the week ahead, that means that the markets are kind of like calmed down on the geopolitical front, but. I think we'll be able to comment a bit further, like once there's like some clarifications provided, and if we see this like extension of the truce or not.
Gotcha. Okay. Interesting. One more question, I think. Do we have time for one more question? Anna, is that okay?
Yeah,
Because
absolutely. Go
this
ahead.
this one's real good. This one actually involves spreads. With
Okay.
bearishness in Asia, how do you
Mhm.
see the JKM and TF spread developing given U.S. supply ramp up?
Yeah, also a very good question. We are seeing like we didn't really touch upon this a lot today, but we are seeing like a ramp up of new supply, especially that's coming from like the U.S. Plaquemines facility and LNG Canada. Even though we know there's some like recent issues with the combustion on one of the gas turbines for LNG Canada, but both have been coming online like a bit quicker than expected. And because of this like availability in the market, we expect like the JKM TTF like front month spreads are going to start like narrowing through late July all the way to October. So right now, I'm talking about our most recent price forecasts. They're showing, if I'm not mistaken, like a spread narrowing down by an average of 30 cents on a monthly basis. But by October, we do expect to see like Europe regaining like a very, very slight premium ahead of the heating season in Europe. On the European side of things, we kind of know that like storage injections are like improving across the region and tracking relatively well compared to like targets. And as we've shown, this is where the Asia side of things comes in. Like we continue to see like a very bearish picture out of Asia, particularly again led by like weaker Chinese demand, higher like inventories as well. So JKM price signals are bearish for now. But I just want to note
Yeah.
that we do update our price forecasts and spread assumptions on a monthly basis. And this is a part of our like LNG monthly report. So the next edition is actually coming out mid next week. So I would like keep an eye on that as well.
Gotcha. Okay. Thank you, Anna. Appreciate the time, everybody in the Q&A. If there's any questions that we couldn't get to in the Q&A, as long as they weren't anonymous, I'll try to follow up directly afterwards with everybody. Maybe give some more context. But no, thank you everyone for joining us today. Again, big thank you to Anna for the deep dive and what's shaping global LNG markets. If you'd like to learn more about this, or have a conversation about how Kepler can support your team, please don't hesitate to reach out. We're always happy to connect here. As you'll see on your screen, we have more America series that are coming up. The State of Play CPP was actually in the past, but we're having another one August 19th. We also have one coming up with container and chartering as well. So we look forward to seeing you guys on the next one. So thank you everybody for joining in, and thank you again, Anna. Have a good day, everybody.
Thank you.